This is Al Brooks, and this is my price action trading course. This module has to deal with trading the opening range, looking for swings on the open. The market tries to form a trend on or shortly after the open on most of the days, and most of the attempts do not look quite good enough, and they fail. But if you look for reliable setups, you can take some swing trades that are pretty profitable, and they're pretty consistently profitable. The opening range is a good time to look for. So when does the opening range end? There's no specific time. It's different every day, usually around 8:30. It might be as early as 7 o'clock, sometimes as late as 10 o'clock. And then the day enters the middle third of the day. And then the final third of the day is the trend into the close, if there is a trend. I tend to divide the day into three parts. So why trade the open if you're trading the first hour or two? Because either the high or the low of the day tends to form early, and that means if you catch that entry, you can swing trade and have a reward much bigger than your risk. So either the high or low of the day forms in the first 5 minutes, about once a week, 20% of the time. Either the high or low forms in the first hour, half of the days. And either the high or low forms in the first 2 hours, 90% of the days. So if you're looking for a swing trade in that opening range, on most days you're able to find one. You should always be looking for major trend reversals, and you should be looking for a breakout of something, either a swing high or low, including the high of yesterday, the low of yesterday, a breakout above a trend line, above a trading range, above a channel, below a trading range, above or below the moving average. Always looking for a breakout of something. Okay, is the breakout continuing from the first bar? So if you from the first bar of the breakout, or is it reversing? So you're not only looking for a breakout, you want to make sure that it continues after the first bar of the breakout. And it's equally important if the breakout fails and reverses. If it's failing, is the market just pulling back a little bit, like to the moving average, and then will the breakout resume? Or is the breakout failing and leading to a reversal swing trade? Okay, swings usually begin with a pretty strong signal bar. So a bull swing usually begins with a bull body and a close at or near the high of the bar. A bear swing usually begins with a bear body and a close at or low or near the low of the signal bar. Okay, breakout or failed breakout. You should see the modules on breakouts, major trend reversals, and on trading strong bull and bear breakouts. On the open, I'm always looking for breakouts, failed breakouts, and breakout pullbacks of anything. Trend lines, trading ranges, prior highs and lows, and I look for reversals. So here we had a big gap down, breaking well below a trend line, and it was a failed breakout. And then we had, for the bear case, this is a pullback from the breakout. We have a small trading range yesterday. We broke below it. We tried to have a failed breakout on the first bar, and it tried to become a breakout pullback, a pullback short, and instead we reversed up a second time. So it's a failed breakout below yesterday's low twice, so it's a second chance to get long. Here we have a bear channel, and we broke below it on the open, and we had a small pullback, so it's a breakout pullback short. Here we tried to form a double bottom major trend reversal, and on today's open we tried to break out above a trend line, and it failed, so we have a failed breakout. Here we have a strong breakout, a gap up and a big trend bar, and we pulled back two legs, a small high two, so it's a breakout pullback. And then we tried to break out of the high two here, and we pulled back again, so a pullback from the breakout of the high two. You should always be looking for swing trades during the opening range. Again, the most common ones come from breakouts, breakout pullbacks, and failed breakouts. So here we have a bull channel going to the close. We broke below it on the open. We pulled back to the moving average. So a breakout pullback short, a small double top at the moving average, a reasonable swing short. We broke out on this day above a double top, and we pulled back. So we have a breakout pullback buy. Here we broke out above yesterday's high, but it failed, and there's a small final flag here as well. So on the open, we raced up, went sideways, and had a brief breakout that reversed at yesterday's high. So it's a failed breakout above yesterday's high and a small final flag reversal. A bear channel into the close, a gap above it on the open, so a breakout, and then we pulled back and reversed up near yesterday's low, so a breakout pullback. We had a bull channel for most of the day, 2 legs down into the close, a high 2, and we gapped up above yesterday's high, trying to break out above yesterday's high, but we reversed down immediately, so it's a failed breakout. We sold off sharply for many bars, and then we rallied back up to the area of yesterday's trading range, and this turned out to be simply a pullback from this strong bear reversal, the strong bear breakout. The first few bars of the day often tell you whether the day is likely to be a trend day or a trading range day. Here we have a strong bear bar closing on its low after gapping up. So that's a trend type bar, and we had decent follow through, so that increases the chances that the day would be a trend day. This chart, by the way, shows you what I mean when I say I tend to divide the day into thirds. Here we had a trend from the open, so the first third of the day, and then we went sideways, and the market had to decide whether the trend from the open was going to have follow through and resumption into the close, or whether it would fail and lead to a reversal day. So you often have a trend on the open, and then a counter trend move or a sideways move in the middle of the day, and then the day decides whether to resume the trend from the open or whether to reverse it. So the current module and the 2 modules following it have to do with exactly this structure. The current module is what to do in the first third of the day. The second module is what to do in the middle of the day, and the final module is how to trade the final third of the day. Okay, the trend from the open, it doesn't have to be from the first bar. It can be 2, 3, 4 bars later. Here we have a 2-bar reversal after a gap up, bar closing on its high, a reasonable swing buy. We have good entry bar and good follow through, so by the time these 2 bars closed, the day was clearly always in long in the eyes of traders. So if you did not buy above this bar, you could buy that close or this close, betting that you'll get at least a measured move up based on the height of the bull spike. Alright, so I mentioned that the first few bars of the day can give you an idea about what to expect for the rest of the day. First bar of the day, a bull trend bar, but a pretty big tail on top and bottom, so a trading range type bar. Next bar, an inside bar, trading range type bar. A small bar, small body, tails on top and bottom, trading range bar. We tried to break out, but a big tail on the bottom, so a questionable trend bar. Next bar, bear follow through, but another big tail, and then another big tail. And then we traded above the high of this bar, so we have a reversal attempt, but a big tail and a doji bar. The trend tried to resume, but a doji signal bar, not good, not reliable, and then a big reversal with a big tail. So lots of reversals, lots of tails, no 2 consecutive strong bear bars. We have 3 bear bars here, but big tails on the bottom. So if you see lots of 2-sided trading, buying pressure, selling pressure, alternating bear and bull bars, prominent tails, lots of reversals, lots of overlap among the bars, and you look at the chart and you say, oh, I don't know if it's going to go up or down. So in other words, you feel confused. If you feel anxious, like, oh my gosh, I got to put on a trade, but none of these setups look right, then you feel anxious. All right, and you see no strong gaps, no bars closing well below the lows of the prior bars, no bars closing well above the highs of the prior bars. Those are all signs of trading range price action, and it increases the chances that the day will be mostly a trading range day, which this was. Yes, it was a reversal day. We opened, we sold off, and we closed back up, but most of the price action during the day was trading range price action. And the first couple bars of the day, and then the first 10 or 15 bars of the day, gave a clue that the day was likely to be a trading range day. The day usually continues the behavior that it had early on in the day. Here's another example. Lots of bars. They're big, lots of overlap, no consecutive trend bars up or down, big tails, top, up and bottom, small bodies. Okay, so this is probably not going to be a trend day, and therefore it's probably going to be a trading range day. Trading range day, you want to buy low, sell high, and scalp. And you expect that all the strong bull spikes will result in sell-offs, okay, and they did. And every strong bear spike will result in a rally, okay, which it did. Okay, the first few bars of the day often indicate whether the day will be a trend day or a trading range day. You should also pay attention to yesterday. If yesterday was a trading range day, today probably will be a trading range day. If yesterday was a good trend day with lots of swings, strong swings, today will probably be the same. The market has inertia, and it tends to continue what it's been doing. The next several slides, the next many slides, is a week of trading the open on the spider. So it's the opening range of the spider for 5 consecutive days. Again, looking for reversals, breakouts, and failed breakouts, and looking to swing using usual management techniques. So I'll go through it one day at a time. Here's Monday, and first 2 bars of the day, big doji bars. Okay, so that tells you trading range price action. And look at yesterday, a tight trading range, and the activity is continuing into today. We tried to break out below the bottom of the trading range, and we have a big bull inside bar. So, and it's also a high 2. There's a high 1 here, and one above bar 1, and then a high 2 here. So I think this is a reasonable buy for a possible swing, but I would be concerned that yesterday was a trading range, and the first 2 bars here are trading range type bars. So this might be a trading range day. However, this is a reasonable buy. All right, the third bar from this reversal has a bull body, probably buyers below, so I would not exit my long. I probably would keep my stop below the signal bar or below the entry bar and then hold. And then look what happened. We had trading range activity again. So from here over to here, lots of prominent tails, good selling pressure on tops of the bars, some bear bodies. Yesterday was a trading range. We tried to break out of the bottom. We reversed up. Now we're trying to break out of the top, and we have a bear signal bar. So to me, that's a reasonable short, especially since it's an expanding triangle. And an expanding triangle top, to me, is a form of major trend reversal, higher high, major trend reversal. So also up here, you can argue this is a wedge. There's a 1 push here, 2 pushes there, and 3 pushes here. So on today, so far, it's also a wedge. So to me, this is a reasonable short. So the market sold off, tried to bounce here, sold off again, and then tried to double top here. Okay, this is interesting, and this is important. The first rally went above the entry price for the bears. It did not go above the entry bar or the signal bar, but it went above the entry price, and then the bear resumed. In general, at that point, I would move my stop to break even. So if I was trying to swing until there was a clear buy signal, at this point, I would have my stop at break even, because I don't want the market to come back to my stop a second time. On strong days, it does not do that. And then look at this rally. The market had 6 consecutive bull bars, so it's looking pretty strong, trying to break out. But look what happened at this high. Okay, it did not hit a break-even stop. That's a sign of strength on the part of the bears, and this is a reasonable second entry short. Your first entry was over here, and now you have a second chance to go short. We're in the middle third of the day here, so this is really has nothing to do with this module, but I'm bringing it up because it's illustrating a point. The bears don't want the market to come back to their entry price a second time, and if they do, they'll exit. If it just misses the entry price, misses the break-even stop, It's a breakout test, and it's usually a good short for a second entry. All right, look at yesterday. We had a strong bear spike, another bear spike here, smaller one here, 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 okay? So it's a series of consecutive sell climaxes, but there was some buying pressure along the way. Tail, tail, bull bar, dojis, tail, okay? Tail into the end, possible one bar final flag, right? Most of the time when you have these parabolic sell climaxes, you can call it a parabolic wedge because it has 3 pushes. Here it actually has 4 pushes. Most of the time, 2 out of 3, the market gaps up the next day and has a pretty good correction. 10 bars, 2 legs, sideways to up. First bar of the day today, a strong bull bar closing on its high. To me, I think it's a possible low of the day, given that we should have 10 bars, 2 legs, sideways to up. We might get back up to the top of this channel, spike and channel. We may get all the way to the top of this channel, spike and channel, right? So to me, I think this is a reasonable buy for a swing up. 1 bar final flag here. Consecutive sell climaxes, it's like any other type of climax. If you get a reversal, the reversal usually goes for 10 bars and 2 legs. It doesn't have to be exactly 10 bars or 2 legs, but usually it's at least 10 bars and usually it's at least 2 legs. So you can buy above the high of this bull bar. The bears tried to sell it off. They could not get below the low of that bar. And now we have a strong bull breakout bar. Its close is above the high of the prior bar. It's a very big bar. It's a close above the moving average. I think you can buy that close as well. You probably have to put your stop down here. So if your stop is too far away, you have to trade smaller. I think that bar is strong enough to flip the market to always in long. Most traders, I think, felt it was always in long when the market went above this very strong signal bar. But this bar, I think, is enough to make traders confident that it's always in long, so you can buy for any reason, including just the close of the bar. Another very strong breakout bar, so if you did not buy this close, you could buy this close. You can see the module on trading strong bull breakouts to get more information on how to trade these things. But now we have 2 very big bull bars, both closing on their highs, very little overlap, small tails, very strong. It should result in a measured move up based upon the open of this bar to the close of that bar. So I think it's strongly always in long. Yep, we have a pullback. That's okay. Tight trading range, a little bit of uncertainty. I think the market's still always in long and it should go higher. So you look for any reason to buy. Here's a high 3. Here's the high 1, high 2, high 3. So it's a triangle and a bull trend holding above the moving average. Bull body for the signal bar. Despite the tight trading range, I think this is so strongly bullish, I think it's okay to buy. You can also argue it's a higher low major trend reversal. We had a bear trend, a very strong breakout of the trend line, and a pullback, pulling back for about 10 bars or so. Yes, the pullback did not pull back very far, but it's still a 10 bar pullback. And I think you can argue that this is a higher low major trend reversal. The rules for major trend reversals in the first hour, I tend to be a little bit looser with the rules because the market so often goes for swings and the setups are often not ideal. And this is what followed. We had a strong bull spike and then a weak channel, okay? Lots of overlap, some pullbacks along the way, a test of yesterday's double top. To me, I would be looking for reasons to take profits. We have an IOI, second entry short. Here's the first entry below this bull bar. To me, I would exit below this bear bar and assume that the market is transitioning into a trading range. Channels usually transition into trading ranges, and we're back up into yesterday's trading range. So this is likely to result in a trading range. So I would exit. Okay, what about the management of that initial long? You buy above the signal bar, the first bar of the day, and your initial protective stop is below the low of your signal bar. Alright, so what happens after we have these 2 strong bull bars? You can raise your stop. Certainly, the first place you would raise your stop is below the most recent higher low, which would be this bear bar, or below the bottom of the bull spike, which would be this strong bull bar. Now, you could calculate your actual risk, which is one tick below this bear bar, to your entry price, one tick below this bar, above this bar, and go for a measured move to twice your actual risk, which is here. Or you can say, gosh, this bar is so strong, we're going up higher, and look for some other reason to take profits. Maybe 2 times your initial risk, below the signal bar, above the signal bar, measure twice that distance. So let's say you did that, you would take some off here. That's assuming you bought over here. If you bought this close or that close, you would go for some other measured move target based upon how much you're risking. Either you're risking below this bar or below this bar. You don't want to take profits too early when you see a bar that looks like this or a bar that looks like that. Alright, so now we have a new high on a trend day. Alright, so far it's a bull trend day. So you probably would raise your stop from below here to below the most recent higher low. Right? If the market falls below this, then your premise that it's a bull trend day might be wrong. You want the day to be making higher highs and higher lows. So after every higher high, you raise the stop to below the most recent higher low. If it falls below this low after going above this high, you have to question your premise that it's a bull trend day. It probably would then be a trading range. And if it's a trading range, you trade it differently from how you trade a trend day. And then up here, this is where you take profits, either below the IOI bar or below the bear bar. And the channel did evolve into a trading range. At this point, you look back and you say, where did the trading range begin? You'd say over here. However, when you were at this point in the day, you'd say, wow, this is a channel and a bull trend. So yes, it's a bull trend, but it's also part of a trading range. Alright, Wednesday, what do we have? We have 2 large legs down in a bear channel, so it's a bull flag, and we broke out on the open with a bull bar and then another bull bar. But the bull bar has tails on top, so probably bear scaling in above. And now we have a bear bar closing in its middle, but we have two-sided trading here. Tails on 1, big tail on 2, bear bar on 3, even with the tail. To me, this is a reasonable short for a failed breakout above yesterday's high. And it's a decent signal bar. I don't like the size of the tail, but it's still a reasonable enough signal bar for a failed breakout, especially since yesterday had a lot of two-sided trading. You have to assume that today will have some as well. Now, you can draw a trend line. You can make it pretty vertical. We can see this bear bar is a breakout bar, right? It broke out of something. It broke out below the low of the open and below these 2 bear bars. But you could also argue that it broke below a trend line. You could draw a very steep trend line here, and that would make this a potential lower high major trend reversal, right? We tried to have a failed breakout above yesterday's high, and the bulls tried to resume, and they're failing again. So we're probably going to trade down lower. So you could short below these doji bars. I prefer to short below bear bars, so I probably would short 1 tick below the low of that bear bar. You can say, well, Al, there are not enough bars in this major trend reversal pattern. Enough bars on the sell-off, 6 or 7 bars, but the rally only was 3 bars. In the opening range, I tend to be more flexible with the rules, and I'm eager to look for swing trades, and a lot of times major trend reversals happen with legs that are not as many bars as I would like to see at other times during the day. So bear breakout and follow through. You could sell that close, you could sell this close. With the big tail on the bottom of the bar, I would be a little bit hesitant, and I would be quick to get out. I probably would scalp this one. So a big bear breakout, we got the sell entry bar, great follow through, so you can sell that close, maybe sell this close. But now we have an inside bar, so a possible 1 bar final flag, and a possible 3 push down pattern. So this could be a parabolic sell climax testing yesterday's closing range. 1 bar final flag, and now we have a 2 bar reversal. either this bear bar and this bull bar, or these two bear bars and this bull bar. On some higher time frame chart, these three bars are a reversal bar, like a 15-minute chart. It might be a perfect 15-minute reversal bar. So to me, it's reasonable to go long. Parabolic wedge, reversing up from yesterday's closing range, and a 2-bar reversal. So you buy above the high of the bull bar. At this point, another bull body, maybe always in long. At this point, a third bull body closing near its high tick. I think most traders would assume the market's always in long and it's going higher. We'll probably get a measured move up based on the open of the start of the spike to the close of the finish of the spike. And that's what I think ultimately we got. Thursday, all right, you could possibly sell this as a low 2, but when the market formed the high 2, especially with the bull bar, you'd get out. You could possibly sell this bear bar, but 2 strong bull bars, not all that reliable. You could buy this 2-bar reversal, but why does it have this big tail? So, there are no great signals so far, and I think it's okay to wait. The high, you got a second entry short, but a doji signal bar, not very strong. The problem is today has an FOMC report, Federal Open Market Committee, the Fed, reporting at 9:30. So, with the signal bars all being weak and the setups all being weak, I would wait until after the report to see if we get a breakout up or down. And this is the report. You can say, well, that's not anything special. Well, it is. These bars had good swings, good size range, and this bar is so much bigger than all of that. This is a huge bar. It's about 1% of the range of the S&P occurring in just a matter of one bar. So this is a huge bull breakout, and chances are it's going to have follow through, and it ended up resulting in a huge day. So you could end up buying on the close of this bar or above the high of this bar or any of these other bars. This is not in the opening range. In the opening range, we really did not have any good setups. But this is a setup in the middle third of the day, and it led to a very good trend. All right, here's another day, Friday. This is that FOMC report and the huge bull trend. And we ended with basically a sideways double bottom, 2 legs sideways, a leg down here, 2-legged move up, another leg down here. So it's a double bottom, it's a high 2, it's an ABC, and then we gapped up, and the first part of the day opened on its low, closed on its high. So we may be getting follow-through buying from yesterday's strong trend. So you could buy above 1 on the first part of the day, looking for a trend from the open bull. Third bar, good follow through. Fourth bar, okay. Fifth bar, another bull bar. So now we have 5 bars up. I would not short below 5. Should be buyers there. This bar fell below that bar and found buyers, and the market turned up. But what happens up here? Okay, we have a reversal bar, a bull body, but we've had a series of strong consecutive bull climaxes without much of a pullback. Here, another spike here, another spike here, here, and then today's open, and then here, and then here. Chances are the market's going to have at least 10 bars and 2 legs sideways to down. To me, this pattern would be consecutive buy climaxes on the 15-minute chart. When you look at the number of bars involved, 40 or 50 bars, I'm not looking for just 10 bars and 2 legs on the 5-minute chart. I'm looking for 10 bars and 2 legs on maybe the 15-minute chart, which means 2 legs but maybe 30 or more bars on the 5-minute chart. So very extreme buying, consecutive buy climaxes, and you can also think of this as a very tight wedge, the high of this bar, and then here the market overshot the top of that trend channel line, the top of the channel. I don't have the trend line drawn in below, but it has a wedge shape. So this might be the start of a big correction. So I think it's a reasonable swing short. Okay, why take it if the probability is not all that good? Because the reward is many times bigger than the risk. The stop is above the high of the bar, the entry is below it. It's a very small bar, and you might get a pullback all the way into this potential final flag. So the reward is many times bigger than the risk. And that is the end of my module on trading opening range swings.